Good day to you. Thanks very much for joining our video. Today we have a team of 2 experts in the estates and trust area, sharing with you on how to deal with some trust in estates and not to pay unnecessary amount of taxes to IRS or state agencies. So today we are looking at the subject of 5 mistakes that cost trusts and estates a lot of money, and presenting life stories is Keith Tokerud. He is an attorney in Great Falls, Montana, and he is one of most experienced and knowledgeable attorneys I had worked in the last 15 years. Keith Tokerud is one of the principals with Scott Tokerud and McCarty, and he is a fabulous team member. I have always feel like I have a wonderful safety net when Keith and I share clients. And I'd like to share a little bit more information about Keith. So let me share my screen. So Keith is a member of Wealth Council. It's a national consortium of estate planning attorneys. And Keith also is an author of the book. So he wrote a book called Estate Planning, and it's a nice and short book, and it has very valuable advice written in a layman's terms. I highly recommend it. And we have Keith's credentials on the screen. If you need to contact him or have questions, feel free to reach out. My name is Lana Kadashnikov. I'm a CPA with JCCS. I work in the Trust and Estate Department, and this is my absolutely favorite area of tax. I enjoy it. I love working in it. Almost work every day with the matters. So we'd like to jump right into our stories based on our experiences. We'd like to share with you, whether you're an attorney, whether you're a CPA, whether you are a staff member at those businesses, or maybe you're a PR or a trustee, or maybe you're thinking about setting up your estate planning. What we'd like to do, we'd like to share with you a few things that could potentially save you a lot of money. And we would be very happy if some of our stories would help you. And now, Keith Tokerud is presenting our first slide.
Thank you, Lana, and thank you so much for the nice words. I just repeat right back what you said. I really enjoy working with you, Lana. You just do a wonderful job for your clients, and I'm so happy to work with you on a team. The first matter I wanted to talk about came up in my practice about 15 years ago, and it really has informed the way I have thought about estate planning ever since. Some people came in, they had estate planning done by another law firm, and they said, we farm out northeast of Fort Benton. We have a large family. There's actually 8 of us kids. Dad's passed away, and Dad had a will prepared that left a trust for Mom, and then eventually we kids inherit. Mom has dementia now. We kids have taken over, and we would like to sell the place now. Doesn't really make sense to keep it. None of us want to farm it, as far as the ones speaking to me said, and we'd like to sell it. So I started working with them to look at that, and pretty soon it became clear that yes, 7 family members wanted to sell, but 1 family member didn't. And we had a trust set up in the will that Dad had left in favor of Mom. So we looked at that document to see, well, do the trustees have the power to sell, or do we need to go to a court, or what do we need to do to deal with this issue where we have 7 family members who want to sell and 1 doesn't? So we got out the will that had been prepared a number of years before, and we looked for the trust, and we found it on about the 3rd page of the will, and the whole trust was about maybe 6 or 8 lines in the will. No detail whatsoever. Nothing about the powers of the trustees to sell or otherwise deal with the property. So to make a long story short, we ended up having to go to court to have a judge say what was going to happen. And we looked at Montana law. There wasn't any Montana law on this. So my firm, we ended up doing research in Connecticut, Rhode Island, Virginia, what the law was over there that could inform the judge here in Montana. And we had a contentious, long time dispute that was very financially remunerative for my law firm. It was very expensive for the family. And the long shot was we are able finally to sell the place, but the family members never spoke to one another afterwards. It was just a tragedy. So the lesson I took from that is, people come in and they say they want simple planning. I don't think that means they want to have a document that doesn't have enough information in there to actually do the job that mom and dad setting up that will want to be done. Simple is fine, simple is great, but we want to avoid going to a court to have a court decide what mom and dad would have wanted 15 years before, when the judge never heard of mom and dad, knows nothing about their circumstances, probably knows nothing about farming or very little. We don't want that to be how our decisions are made. We want to have a detailed agreement where we just look at page 13 of the document and we see what provisions we're going to follow, and we're done. We never think about going to the courthouse. So that's my first example, Lana. Before we ever even start thinking about trust administration, we want to set up our planning, and we really want to take the time to think about what we want to have happen and then get it documented to avoid the kind of family dispute that I'm talking about.
And Keith, I just wanted to say that recently myself and my co-worker were working with a trust, and having those details, especially like what if scenario, we were working with a trust document that was drafted by your office. And what happened, we had a mother pass away and her daughters were inheriting the trust. Well, one of her daughters passed away within very short period of time. And your trust document did have that provision: if somebody passes away, this is what happens. And I was so grateful that the details were there, because we had clear indication of what to do. So I agree with you. I wanted to talk about maybe a general mistake that sometimes causes trustees and PR to cut a larger check to IRS than necessary. And that area is procrastinating, not getting things done timely, or getting them done in the last minute. And we all have lives, we all have different things that we need to do. Unfortunately, with anything that concerns with IRS paying taxes, doing things in the last minute sometimes causes to overpay tax. So I do have an example of a young personal representative. This was the youngest personal representative I've worked with. He was 25 years old, a young kid out of Helena. Both of his parents passed away, and he was doing an excellent job for his age. He was very, very mature. He brought his paperwork in March. It was middle of the March. That's when the financial institutions issue the 1099 forms. And as soon as he got them, he brought them to the office and he said, Lana, let's look at this. We need to file an estate return. Well, lo and behold, this estate had a large income coming through. And because of the time, middle of March was too late for us to do one of the elections that would allow us to pay a smaller amount of tax. And what happens is, inside the estate, if there is income that needs to be taxed inside the estate, we're paying highest tax rate if the income is over $13,000. However, if you take the same income of $13,000 and spread it against among beneficiaries, then your tax rate is much, much lower. It could be 12%, it could be 22%, much lower than the highest tax bracket. And so with this situation, even when somebody was thinking they were doing great thing and being on time, in this case, the estate ended up paying $13,000 of extra tax just because we couldn't move those distributions. We couldn't make the distributions to beneficiaries in the right time. Second area for not doing things timely deals with when some PRs or trustees are having to manage the assets of the estate or trust. There are things come through as income items, as expense items, and so we did have one estate, farm estate, where we had the PR. He was busy. He had a full-time job. He was busy, and so what happened? He was kind of late doing his paperwork, so he brought us his things after the fact, and it was 2 years period encompassing estate activity. And so what happened in the first year, there were sizable expenses to the tune of like $35,000 to $40,000. So inside the estate, the PR wanted to make sure that he paid the attorney, paid the accountant, paid his PR fee, paid off some other things. Well, what has happened later, that first year he paid the expenses. Well, second year, there was $50,000 of income coming through. And unfortunately, just unfortunately, that $35,000 of expenses, they were lost. Nobody could utilize them. And then in the second year, the estate ended up paying tax on $50,000. If that same PR was able to talk to an attorney or CPA and talked over, these are the expenses I need to pay, the high tax could have been avoided if we could match those expenses to the time when the income comes, and taxable income would have only been $15,000 instead of $15,000. Also, not having any planning, not knowing when things come or when things need to be paid, unfortunately creates situations like this. And my third example with procrastinating is relates to S corporations and partnerships. So generally, we know that partnership return and S corp return, they don't have their own taxes that need to be paid. So a lot of times, folks think that, hey, because I don't pay tax inside this entity return, I can file a little bit late and that's going to be okay, because the owners of this S corp or partnership will pay the tax. So in the states that have partnership share or S corp ownership, it's very, very wise to make sure that those tax returns get filed on time or extension forms get filed. Because if those don't get filed on time, there is a $210 penalty per month per owner in the pass-through entity. I do have a co-worker at work that has a new client. They have a partnership inside an estate, and they haven't filed partnership tax return for 3 years, and they have 4 partners. So the amount of penalties is just horrendous. And it's and for us, for people who do professional work in areas of estate and trust, when we see this is difficult for us as well, because we want to help PRs and trustees have the efficient administration of things. So when we see a lot of money being paid to IRS or Department of Revenue or other state agencies, we wish that things could have been different. So we love working with our clients and having other kind of stories, the success kind of stories. So that was my overview of procrastinating and what high taxes it could cause. So
can I jump in here before I go to my
yeah, absolutely.
Statement? So procrastinating doesn't necessarily just involve the clients, it can also involve the lawyer. So when we have a family come in and say we've had a death and we either need to do a probate of a will or a trust administration, we think it's imperative that we get hold of a Lana, and sometimes specifically you, Lana, to get you on board sooner rather than later, because a lot of us lawyers know a little bit about tax law, some more than others, but we don't know anything near that with the depth that you know. And if we don't get you on board as a team member early on, the same kind of problems you're talking about where clients procrastinate are going to be a problem in the estate where the lawyer has procrastinated getting together with you. So I just want to, I guess it's a little plug for what I call team-based planning. When we're doing estate planning, when we're doing probate, we're doing trust administration, the lawyer has a role, of course, but so do you, Lana, and we want you involved from day one to get the best job for the client. So I just wanted to throw that in.
Yeah, thank you very much for your trust. And likewise here, when I have clients sitting across me from my desk and they're talking about their spouse, say if I have a client who is nearing retirement and they're complaining that their spouse's health is going down, I do have those thoughts of I need to connect them with an attorney. Maybe they'd like to do some Medicaid planning. So I try as much as I can when I hear the first little bells of what could be done to help them preserve their estate or preserve their funds. I think of you and I think of your team as well.
Okay.
All right, let's jump to our next slide.
Yeah, well, so on this slide, I want to talk a little bit about some issues that may not really seem directly involved with estate planning or estate administration or probate. And that's the business arrangements that we make when things are going great, when we're still here and we're just going about our business. That can have some major consequences down the road when someone has passed away. So for instance, we represent a lot of farm and ranchers. They're concerned about paying estate tax, of course, because farmers and ranchers have high value assets and not only sometimes not that much cash to pay estate tax. Well, Uncle Sam recognized that a long time ago and said, if you qualify, we will let you pay a lower rate of estate tax on your farm assets, only if you qualify. And the qualification has to do with whether before death, the family is actively engaged in farming or ranching. And we can be actively engaged by being up there in the field and doing the work, or by having a crop share lease or a calf share lease. We're not going to be actively, it's called materially participating, if we have a cash lease. Big deal. Another aspect is, in order to qualify for benefits, including this what's called special use valuation, the farm assets need to be a certain percentage of the total estate value. Well, if early on, mom and dad said, I think it's a good idea to start gifting some property to the kids early, it may seem like a good idea, but if down the road it disqualifies us from being eligible for special use valuation, that's going to cost the family quite a bit of money. And along the same lines, there's another huge benefit that may be lost if we don't think ahead of time about our planning situation. And that is, if we haven't got things in an order, when someone passes away and there's estate tax to be paid, Uncle Sam says, no problem, just send us a check for the full amount in 9 months. Well, that is a problem for many people. Either they don't have the cash and they need to have a fire sale, or somehow come up with this cash, or sell assets when they otherwise wouldn't want to. But if the family qualifies, because among other things, the business assets percentage of the estate is large enough, we can pay over a number of years, 15 years, at a very reasonable interest rate. Well, that can make all the difference in the world in terms of being able to continue on operating and not. All because we didn't make some transfers, we didn't do some transactions during our lifetime before we were ever thinking about estate planning that disqualify us from that benefit. So once again, my point is, when we're doing our business planning, let's also be thinking about estate planning, even though it seems like the last thing we need to worry about. Mm-hmm. Lonnie, you've got an example about an S corporation. What's that all about?
I'm a co-trustee on a trust that owns a portion of an S corporation. And so the S corporation is a standalone business. There is a president of the corporation. There is a board. They're running full-blown business. And so when you have an owner who is a trust, there are special rules that apply to trust that make things a little bit more difficult. So I have to remind this business every year I have to remind them and say, if you're going to buy equipment, we cannot take the special depreciation. We cannot take Section 179 depreciation because trusts are not allowed to have a deduction for Section 179 depreciation. And if you have not heard about this, Section 179 depreciation allows you to deduct the full cost of your equipment or your assets in the year of purchase. And so every year I have to remind them about this. There is maybe bonus depreciation that's available or regular depreciation, but not Section 179. So it does, on Keith's slide, it's related to when you do some planning, when you run a business, if you have some connections to trust and estates, it pays off to consider those estate or trust issues and to know those laws and not pay IRS more money than necessary. All right, and I have mistake number 4. Some clients fail to claim portability. And so portability applies to married couples. So when you have first death, so one spouse dies, this is the time when portability could be claimed. And if I wanted to simplify it and give you an analogy, portability is like having I don't owe you piece of paper that says later on in my life, I will not owe you taxes. So here's an example. Say the husband dies, and if you look at all of the assets that the husband has, let's say there is $4 million worth of assets. And let's, for simplicity of the example, say that the estate exemption is 11 million. So the husband has 4 million worth of assets, but the government says, hey, you could have had 11 million and you would not pay wealth transfer tax on it. So there is $7 million worth of assets that potentially you don't have to pay tax. And so at the time of the first spouse to die, there could be a tax return prepared that could say, this is equivalent to, I do not owe you tax on $7 million in the future when the wife would die. The problem is to get that report done, to get this, I don't owe you money in the future, you have to pay CPA a fee to file that tax return. So that's the only detriment to doing this. There is a second area that limits your opportunity to claim portability. You can only get this form filed within 2 years of the first spouse's death. And so I don't have any examples where we failed to claim portability. I don't have a client who ever came back and says, well, I should have done it and I did not do it, because we encourage everybody to file those returns because it serves like an insurance policy against possible changes in life situation, because somebody could inherit unexpected sums of money from some unexpected sources. Somebody can remarry, or somebody can have lottery winnings. And those are things that need to be considered. Yeah, in our office, one of my co-workers, one of the shareholders, I think Keith, he has a case with you where there was a married couple and the husband passed away, and so it's been at least a year, I think, since the husband's death. And I believe you and Dan are talking about portability, and you're talking with the surviving spouse about maybe necessity of filing that report.
Yeah, well, in this case, Lana, it was a couple that said, when both of us are gone, we'd like to leave our estate to charity. Mm-hmm. And now the husband's passed away, and we raised this issue with the wife. You know, ma'am, we would suggest that you might want to file portability, because right now you don't need it. When you pass away, there'll be a charitable deduction for the full amount of your estate. There won't be any estate tax owed. But you have other family members, and as you get older, now you're by yourself, it's going to be a different situation. People may come to your aid whom you want to include in your estate, and you've got the right under the estate planning documents to change your planning. But why don't we elect portability so that if you do make that change, we're going to minimize any estate tax that would reduce what you want to give to these family members that come forward. So it's not as if we have to do it, but we want to, your partner, Lana, and I suggested to the client, let's just incur that very reasonable expense paid by this, paid to the CPA firm, and file the portability to give you, ma'am, the flexibility later on to change your planning and still get the best tax result. And she said, okay, I hear what you're saying, let's do it.
Wonderful, wonderful. I'm happy for that outcome. Very good.
Yeah, well, this mistake I mentioned before, but I want to give the example of what the difference is here. So what I said before was, when you are doing your lifetime transactions, you need to be thinking about estate tax ramifications, even though it seems like the furthest thing you need to worry about. And one thing is, if you give away more property than you otherwise, we'll say, should, you may disqualify the family down the line from being able to pay estate tax in installments. Well, in this case, the business person was a very astute business person, but he never thought about estate tax issues when he was dividing up his estate, and he made some lifetime transfers. So when he passed away, we did not have a high enough percentage of his estate composed of his business assets. We were close, but we weren't high enough. So the estate had to come up with only, Lana, only $4 million of tax in 9 months. Luckily, the family was able to do that by selling some assets. I'm not sure they got as much value as they would have from those assets if they had more time to sell them, but they were able to scrape and pinch. But boy, we went through some white knuckle weeks and months to get that in place. So it was a very close call. They didn't have to close down the business, but we came just within a whisker of having that be the situation.
Yeah. So what I wanted to do is jump to our next slide that's titled Success, because Keith and I love for any of our clients to have an example of success, to be efficient, to pay as little tax as possible within the guidelines of the law. And so what does success equate to? Having detailed plan in your estate planning, having timely meetings with your professionals. When planning, even if you're not at the retirement age or your clients are not there yet, consider longer term effects for your business. That someday, maybe in 20 years, it may be inside the estate or inside the trust. For clients whose spouse has passed away, maybe consider portability to allow flexibility to yourself to make more choices that would not cost very much money and very much tax. And estates that have businesses, it's really good to talk to your attorney and CPA and know your options with different tax rules. I do wanted to share with you of what the personal representatives or the children of the decedents say to me when the estate is closed and they talk about success, and they say, our folks' estate was easy to administer. It was easy because our folks were smart and they had 3 individuals or 3 teams that were helping them. They had good attorney, they had good CPA, and they had a good financial advisor. And you as a listener, you might listen and say, you know, those professionals are just doing plug for themselves. And to me, it doesn't matter that you come and see me. It just matters that something gets done efficiently and nobody is overpaying taxes. It could be somebody else, another CPA or another favorite attorney. But what repeatedly our clients or kids of the clients have said to us, if you have a team of three professionals, attorney, CPA, and financial advisor. Then most likely your plan is going to be well ironed out, and the people who come to deal with your assets after your passing are going to have a great time, and they're going to say, this was a success, this was wonderful. Keith, do you have any parting thoughts?
Well, I guess, Lana, the only thing you didn't put on that success slide was a point that I made earlier. I think you want to work with professionals, and I'm thinking of lawyers who, we lawyers were famed for having outsized egos. You want to work with professionals, including lawyers, who see the value of working with a team of professionals. First of all, when you're doing planning with them, they don't just push planning down your throat. They let you, client, have a clear understanding of your options, let you be in charge of the process. But then the lawyer involves the financial advisor and the CPA. The CPA involves the other professionals so that we can all bring what expertise we have to the situation and maximize the chance that the family is going to be benefited from, is going to emerge from the estate administration process united and still a close family, as opposed to some of the results we otherwise see when people don't do that. So that would be the only thing I would really want to add.
I agree 100% with you, because to me, there is no monetary value you can put on relationships between the kids. And having success relates to, hey, parents had 4 kids, and 4 kids are close, they're talking to each other, they're spending holidays together. There is not enough money that you can put a value on that. So I agree with you. I just want to say thank you very much for joining our video. Keith, thank you very much for your wonderful stories. I appreciate it. And I look forward to working with you as a team on our common clients.
Sounds great, Lana. Thanks so much.
Thanks. Have a great day. Bye now.